On a Tuesday morning in February 2023, a 58-year-old property manager named Sandra walked through the lobby of a 34-story office tower in downtown San Francisco. The building had been fully occupied in 2019. One of the Big Four accounting firms had occupied 12 floors. A major law firm had held 7 more. Sandra's job was to manage the property for a pension fund that had paid $543 million for the building in 2017. She walked past empty reception desks, past dark conference rooms, past abandoned furniture that nobody had claimed when the leases expired and were not renewed. The building was 42% occupied. The pension fund's lender was calling. The building's appraised value had just come in at $192 million, a 65% decline from the purchase price. The pension fund could not cover the loan. Sandra was let go that afternoon. She drove home through streets lined with storefronts that had not been occupied since 2020. What happened to that San Francisco office tower is not a local story. It is not a San Francisco story. It is a national story, playing out simultaneously in every major American city, inside the balance sheets of hundreds of banks, most of which have not yet been required to publicly disclose how bad it actually is. In commercial real estate, the losses accumulate in silence long before they appear on a balance sheet. Here is the structural problem in its simplest form. Between 2015 and 2022, commercial real estate, office buildings, retail centers, hotels, apartment complexes, was the preferred collateral for an enormous wave of bank lending. Low interest rates made real estate look attractive. Cap rates compressed. Buildings traded at valuations that assumed near full occupancy, continued rent growth, and the persistence of interest rates near zero. Banks wrote loans against those assumptions. Life insurance companies wrote loans against those assumptions. Regional banks, the mid-sized institutions that are the primary lenders to American small businesses and commercial developers, wrote an enormous amount of those loans. By 2023, approximately $5.6 trillion in commercial real estate debt was outstanding in the United States. Of that, approximately $1.5 trillion was scheduled to mature, to come due for refinancing, between 2023 and 2025. The problem, the interest rate environment in which those loans would need to be refinanced, was completely different from the environment in which they were originally written. The Fed funds rate had risen from 0.25% to 5.5% in 18 months. A loan written at 3.5% in 2019 now needed to refinance at 7% or higher. The math, for thousands of properties, does not work. When a loan cannot be refinanced, the borrower has 3 options: inject more equity, sell the property, or default. And in the current environment, where buyers know that sellers are desperate, where vacancy rates in major urban office markets are at historic highs, and where the extend and pretend flexibility that banks offered during COVID has run out, default is increasingly the only viable path. 3 case studies, each one a specific, documented collapse that reveals the mechanism. First, PIMCO's Columbia Property Trust. In February 2023, PIMCO, one of the largest bond investment managers in the world, allowed its Columbia Property Trust Fund to default on $1.7 billion in office building loans across 7 U.S. cities. The buildings involved were high-quality assets in major markets: New York, San Francisco, Boston. They were not distressed properties bought cheaply. They were trophy assets bought at peak valuations, financed at low rates, that could not be refinanced profitably in the new rate environment. PIMCO, with $1.7 trillion under management, chose default over injecting equity. That decision tells you everything about the math underlying the commercial real estate market. Second, Brookfield Asset Management. Brookfield, a Canadian real estate giant managing $850 billion in assets, defaulted on more than $750 million in Los Angeles office loans in 2023. Again, not a marginal player, not a poorly capitalized developer. One of the most sophisticated real estate investors in the world, making a calculated decision that walking away was better than throwing good money after bad. When institutions of this caliber choose default, it is not a sign of weakness. It is a signal about the asset class itself. Third, New York Community Bancorp. In January 2024, NYCB reported a surprise quarterly loss driven by commercial real estate loan losses, cut its dividend by 70%, and watched its stock drop 38% in a single day. NYCB was not a small bank. It had just acquired Signature Bank's assets following Signature's March 2023 failure. The losses were concentrated in multifamily and commercial real estate, the sector that the bank had built its business model around for decades. Within weeks, Moody's downgraded NYCB's debt to junk. The bank received an emergency cash injection from investors, including former Treasury Secretary Steven Mnuchin. The crisis was contained, for now. The NYCB situation points to the systemic risk that regulators are most reluctant to discuss publicly. Commercial real estate loans are concentrated in regional banks. The largest U.S. banks, J.P. Morgan, Bank of America, Wells Fargo, hold roughly 15% of their loan portfolios in commercial real estate. Regional banks hold, on average, 28%. Community banks, the smallest tier, hold more than 40%. These are the banks that lend to small businesses, that finance local construction, that hold deposits for millions of American families and businesses in mid-sized cities. The Federal Reserve's own research estimated in 2024 that approximately 300 small and regional banks face potential insolvency risk from commercial real estate exposure if office vacancy rates remain at current levels and refinancing pressure continues. These banks collectively hold more than $800 billion in deposits. The mechanism that makes this a systemic crisis rather than a series of isolated failures is the same mechanism that turned subprime mortgage losses into the 2008 financial crisis: interconnection. Commercial real estate loans are packaged into commercial mortgage-backed securities, which are held by pension funds, insurance companies, money market funds, and bank investment portfolios. When a property defaults, the loss does not stay with the originating bank. It radiates outward through every institution that holds a slice of that security, affecting portfolios that most investors do not associate with commercial real estate at all. The extend and pretend dynamic, where banks roll over troubled loans rather than recognizing losses, is already operating at scale. Regulators have given banks unusual flexibility to avoid marking troubled commercial real estate assets to market. Critics have called this the same mistake made with subprime mortgages in 2006 and 2007, when loans were held at face value rather than market value until the scale of the losses became too large to conceal. Sandra, the property manager who lost her job in February 2023, found new work 6 months later. But the building she managed has not been refinanced. It has not been sold. It sits in a loan modification arrangement. The bank's balance sheet says the loan is performing. The building's occupancy has not improved. The math has not changed. The question that should concern every American who has money in a regional bank, a pension fund, or a money market account is this: how many of those performing loans are performing only on paper? Because the last time that question had a bad answer, we called it a financial crisis. And the people who are supposed to tell you the answer have every financial and political incentive to keep extending and keep pretending until they can't.